Hello, everyone. I'm Toby Schifsky. I am the Vice President of Dearborn Real Estate Education, and you're here for the Dearborn webinar. We're doing maximizing deductions and year-end tax savings, the strategies that go behind that. And we have none other than Zach Prim with us. Zach, hello.
Hello, everybody. Hello, Toby. Hello, everybody.
Let me just tell you who Zach is and why he's here with us today. So Zach is a seasoned tax strategist, right? So and advisor, and with over, I think it's over a decade, right, Zach, of
Yeah,
experience.
oh, yeah. It's about
Yeah,
13 years here at Business by Design now. So,
yeah, very nice. So helping business owners, entrepreneurs navigate some of the complex tax landscapes, right? And he specializes in crafting innovative, I think, practical strategies that optimize tax outcomes, minimize risk, which we all want, and align with long-term business and financial goals. So, Zach, thank you for being here today and sharing your knowledge with us.
yeah, absolutely. Toby, thanks you for having me. And thank everybody for joining in. I don't know if everybody loves sitting on a webinar to discuss taxes, but we're getting to that time of the year where it is very important. And Toby, do you want me to take over from here?
Yeah, why don't you go ahead and drive? So here's the deal. Go ahead and do it, Zach. Zach has
Hmm.
prepared kind of an outline slide deck for us that we're going to go through. We're going to hit it kind of fast. There's a lot of ground to cover, and I think there's a lot for people to get it. And if you're viewing, if at any time you have to jump off and go somewhere else, don't worry. This video will be edited, appropriately, and then shipped out within a week to you to the email address that you registered for the event for. All right. So Zach, take us through.
Yeah, of course. Again, thanks for having me. A lot of things to try to squeeze in here in like half hour, 45 minutes as far as like what do we need to do from a tax planning standpoint. But I'm gonna go through and hit on some of the high points as far as like, what do you need to do? What's your relationship with your taxes? What can you do between now and the end of the year? And then more like long-term planning strategies as well, because taxes are never going away. Is whether you think the IRS can be abolished or not, it's a different question. But taxes are a year over year thing, right? We're always dealing with that. It's one of your biggest expenses if you're a business owner, usually something that you need to start looking at and planning for. So I'm gonna go over some of the items that we can do today as far as like what can we still do before year end, and then also, again, like I said, longer term planning as well. So some of the questions that I see when I deal with maybe people who are maybe not involved in their taxes as much as maybe they ought to be, or maybe they have an accountant and they're not really sure what that relationship is these are some of the questions or items that I would maybe want people to start asking themselves of what they're or how they interact with their taxes. Do they have planning or do they have just preparation, right? If when you meet
Uh,
with an accountant, do you even have an accountant? Is that just simply dropping stuff off and filing a tax return and getting things done? And hopefully that tax number that's on the tax return is close to what you had paid in. A little bit of a mystery. What does that communication look like, right? Are you having a meeting once a year with your accountant? Or is this something where it's like, hey, there's more comprehensive tax planning where you have multiple touch points throughout the course of the year to kind of have like almost like a bedside manner, check in on your taxes and then discuss strategies that could still be implemented. Again, for us here at Business by Design, year end is really our busiest time of the year, which I think a lot of times people will get confused. They're like, well, wouldn't it be March or April when we're filing taxes? We're busy then too, but the year end is really when we do most of our tax planning. This is what I want to stress for anybody here who's listening is do you have a plan for the end of the year, right? Because you only really have until 12/31 to make a lot of decisions before things just end up on that tax report card, which is in March or April. And then another question that people I think should be asking themselves is, are my taxes a mystery? In all honesty, it's just math, right? It's very complicated math to try to get to your tax number, but somebody should be having a conversation with you to help you understand where are my taxes at? What is that number? What do we need to do to attack that number throughout the course of the year? And then are there different strategies we can do to reduce that? And that's some of the things I want to talk about today is what can you do to reduce those? Theory versus actionable steps, right? We all hear about the TikTok tax advisors out there of saying, hey, go do these things, take a big deduction. Well, some of that can work, but it's got to be actionable, right? We got to go down the right paths, make sure that those are compliance based as well. Sometimes I deal with why is everything a no, right? So it'd be like my accountant tells me I can't do anything. Well, there are certain things that we're very strict about, right? It'd be like, hey, don't commit fraud or anything like that. And then there's also different rules where there's tax guidance, tax law that kind of puts us in that direction. But we also want to start thinking about like, hey, maybe it's not a no. Maybe we need to shift how we think about this and attack it from a different angle. And then really, are you dealing with, your tax person? Are they a problem solver or are they task based, right? Are they just simply checking the boxes on those things? Now, I'm going to go through some questions here. I kind of, as we go through this, through some of the material I have here today, I want you to ask these questions of yourself of like, do I need an entity, right? What is the right entity choice for me? So we'll go through some of those options that are available to you. What is my marginal and effective rate? What is Cubit? If you're a business owner, this is an important item for you to understand. What is PTE? If you're a high income state, PTE is another thing that we maybe want to look at. Can we abolish the IRS? I hear this question a lot. It's people say the IRS isn't even constitutional. Well, they're still collecting cash, right? And this is one of those things here in the state of Minnesota. We recently had a big case kind of blow up about like actually not paying taxes. You should be paying your taxes if you owe them. Stay current, have a plan. It's what we're going to discuss today. And then, do you really need an advisor, right? Because what I would say is, in the world of tax, it's very complicated, and it's nice to have somebody guide you along that path. But if you are in an instance where like maybe you're just starting out, or maybe there's not a lot of income that's being generated, you maybe don't need to be paying thousands of dollars to have a tax advisor, right?
Right. Right.
Um, Toby, any questions based off of the first couple of slides here?
No, I'm kind of excited because I think about
Yeah,
myself, running a business, my own business for years and years and years, and the taxes were a mystery. I'll just be honest; they were a mystery. I was really good at doing, my business, which is a real estate land development business. I was really good at that. I wasn't really good at tax planning. In fact, the tax man was a boogeyman. I mean, it was like, God, do I have enough to cover? What am I? What? Because I didn't do tax planning. I had somebody do my taxes, but there was no tax planning involved. There was no strategy. It was, oh, this is what you did, and I didn't find out till years later, that I had wasted thousands and thousands of dollars from not having simple conversations with people who understand the kind of strategies that need to be employed in order for you to really operate within the rules and laws that the tax code allows you to do. And in
right.
fact, expects you to do. Uh,
Yes.
it, I mean, and because that's why they have the rules. They expect you to operate by the rules. And so, be they way advantageous, be they, really kind of draconic. But having somebody who really lives and breathes and does it all day long, I found that to be the big advantage when it came to somebody actually consulting with me about
Yeah.
planning as opposed to just doing my taxes. So just thought I'd throw that in there because I know we got
Yeah, yeah.
our operators, the school operators on here, and they're looking at it, and maybe the tax man is a boogeyman to them too. So
Yeah, yeah. And I appreciate you saying that because I think a lot of people feel like this mystery or anxiety around taxes. And a lot of times that's because there isn't like a plan, right? People feel, us as humans, we just naturally feel better when there's a plan, or at least somebody's telling us there's something that's happening. And it's tax prep and planning is almost kind of like akin to keeping up a vehicle, right? So if you're like, hey, I don't do anything with it, I'm not going to do my oil changes, and then all of a sudden you go in to the mechanic and they're like, hey, your car's all jacked up. It's going to be expensive, right? Instead of saying, hey, you should have been doing that maintenance, those check-ins to make sure this thing is running properly. It's the same thing for taxes. And
yeah,
unfortunately, just in the world of tax, it can get very ugly very quickly if there really isn't a plan, right? And somebody's not communicating. And this is one of the things that I tell a lot of my clients is, I don't need you to become a tax professional. I don't want you knowing tax code. I don't know, need you to go into the exact detail on these things, but I want you to be, having a working knowledge of certain core concepts so that when we connect throughout the course of the year, we're making informed decisions and you're making informed decisions. And I'm not, as an advisor, just telling you what to do. There's a little bit of that sometimes, but for the most part, you're the entrepreneur, you're the business owner. I want you to make informed decisions so you can grow your business. And again, to your point on this as well, the IRS wants you to succeed. They're the silent business partner. They're the one in this group that in the group project that doesn't do any work but gets a portion of the benefit, right? They want you to make money because if you make money, they get taxes, right? So this is why we want to understand how the tax code is set up. It's all above water. It's the IRS's, like Toby said, it's put out there for you to take advantage of it. So I'm going to go through a couple of things here. One of them is, I'm sure you've all heard of the one big beautiful bill. Whether you think it's beautiful or not is everybody's own opinion. But if you're a business owner, it's a pretty good thing, right? We'll talk about some of the changes here, some of the tax rates for 2025, entity overview as well. Toby and I were talking about this prior to our call here. Is sometimes I think people are maybe not sure of what entity they need to be in, right? And there is no exact like hard cut, like you need to be in this one, but there are some thresholds, and we'll talk about that a little bit later here. Usually it's monetary based of like, hey, if I've made enough income, I probably need to start looking at a different structure. And then business expense updates, and then some smart tax moves for 25. So the big beautiful bill. So if you're self-employed, tax law changes have changed a lot since 2017. OBBBA kind of makes a lot of that permanent, right? So back with 2017's TCJA, there was qualified business income deduction, standard deductions, and a few things have changed. OBBBA is basically making that permanent. So some of the things that are happening is tax rates or tax brackets are made permanent for what they were for 2017. Adjustment, it's essentially like a 1 to 2% reduction for all brackets, right? It's, sometimes you're like, well, it's only impacting the rich. It's impacting all brackets. So it's roughly a 1 to 2%, a little bit different here in different brackets, but that's kind of the general assessment. Standard deduction has been increased as well this year. It's 15,750 for singles, 3,150 for married filing joint. Whether you
was it before,
itemize.
Zach? What was it before?
So for this year, it would have been under 15. It was 14,600 for single. And then OBBA changed that to 15,750. Every year it's indexed for inflation, goes up a little bit. Yep, always ticks up a little bit. So oftentimes the question, and I'm not going to get into too much detail here today, but you want to know, do you itemize or you take the standard deduction? Itemizing for just quick conversational purposes, charitable contributions, maybe health or medical expenses if you reach a certain threshold, and then charitable contributions in state and local taxes. State and local taxes, especially I'm here in the state of Minnesota, we're a highly taxed state. There is some reduction there as far as what you're actually able to take as a deduction on your itemized deductions. That cap has been at 10 grand since 2017. There is a workaround. Oh, go ahead.
Is that the salt tax?
That is the salt cap. Yep, exactly. So when you hear the salt cap, they're not talking about what you need to put on your table with salt and pepper. It's literally the state and local tax deduction that you would have as an itemized deduction. That's been capped. So if I say I made $50,000 worth of state payments to Minnesota, well, I was only able to take $10,000 worth of that as a deduction. Now, business owners had a separate route that they could go down. We'll talk about that a little bit later, but that's also something you need to know is PTE, pass-through entity tax credit, especially if you're in an income tax state. If you have a no income tax state, don't worry about it. And each state does it a little bit differently. So I'm going to go broad strokes and kind of utilize what Minnesota has.
Perfect.
Child tax credit's been increased, right? $2,000 to $2,200 per kids. During the whole conversation about taxes, we were talking about no tax on tips, no tax on overtime. Well, that didn't really come to fruition. There's a deduction and there's certain income thresholds or phase outs. So just be aware if you are somebody who has overtime or tips, you should probably look into this a little bit more, consult with an advisor to say, hey, this might actually impact my taxes this year. Auto loan interest, we'll see. This is one of those where it sounds great, but again, it's got to be that vehicle's got to have final assembly in the United States. And then there's also some income thresholds as well. But essentially, this would be outside of just itemized deductions. You might be able to take some of your auto loan interest if it's a new vehicle to you and then final assemblies in the United States.
So not necessarily a new vehicle, but new vehicle to me.
This one actually has to be new. So what you're talking about is bonus depreciation. So we'll talk about the vehicle expenses. That's a little bit different because this also impacts that as well to say, hey, if I'm going to take bonus depreciation on a vehicle, I have to be aware of the auto loan interest deduction on the personal side of things.
I was personally interested in this auto loan.
Yep. And one of the things with this is the world of tax. Every administration comes in and says, hey, we're going to clean this up. We're going to make it less complicated. I've been doing this for 13 years. The thing just gets more and more complicated, which again, kind of helps me and my staff, I guess, because it just solidifies the need to have an advisor to say like, hey, this is getting overly complex. I want my business owners to be focused on doing what they do best, which is running the business, right? And 2 to 3 touch points throughout the year is the only times I want you thinking about taxes.
Got it.
Cubit is the big one, right? So qualified business income deduction, for those who don't know, essentially, and there's certain thresholds here, so I'm oversimplifying, but essentially, if I have $100,000 worth of profit, I get a $20,000 deduction if I qualify for qualified business income deduction. This was back in 2017, so this was to help those who are small business owners, those who are self-employed. You get a deduction for essentially just being self-employed. Usually, you'd have to spend money on like retirement, hire an employee, reinvest into your business to be able to get that deduction. Well, this Cubit deduction, that's been made permanent
Yeah.
until like the next administration comes along and changes anything. But Cubit is back. It's at 20%. It's for the foreseeable future. That was
And
supposed to
that and that
sunset.
is for sole proprietors, S
S
corp,
corporations,
LLC
partnerships.
partners, right? Of that,
Yep.
right? So
Yep. The only one.
that's the majority of the people who are the people going to be attending this. So
Exactly right. Yep. And that's one of those things where had this gone away, you go into 2026, you're filing your 26 taxes. You say, hey, I made the same amount of money, maybe a little bit less. Well, your taxes would have gone up, and you've been like, why? Right. Well, that's because if Cubit would have gone away. Well, that's now here, right? So it's there permanently.
permanent.
Um,
Okay.
Seniors deduction, if you hear about that as well, basically 6,000 per person for a deduction. You know, when they say, hey, no tax on seniors, well, there's still tax. It's just, again, same thing with thresholds of phase outs. And then you potentially have 6,000 or 12,000 married, filing, and joint for a reduction there. Salt cap has increased to 40,000, again, for those who have something like an S corporation. PTE, especially in the state of Minnesota, almost always still going to come out better for you. It's kind of a more bespoke conversation you should have with an advisor to see what works best for you. Green energy credits, EV credits, those are basically all gone. And then estate tax exemptions. And then the Trump accounts are actually pretty cool. Whether you call them Trump accounts or whatever you want to call them, $1,000 is going to be essentially invested into a tax deferred account. You can still contribute to that as well outside of that $1,000. I think it's like 5 grand. We're still waiting on some details from the Treasury as far as how this works, but the government's giving you $1,000. That compound interest over the years, if you add into that, can really be beneficial for people, you know, who don't maybe have savings to begin with. So just something to be aware of. 100% bonus depreciation back, that's huge, right? So this is something that we're going to be at 40% for this year. Well, 2025 now, it's back up to 100% after January 19th. Again, more political reasons, but after January 19th, if I were to buy a vehicle, place it into a service, and it's 100% business use, I might have 100% bonus depreciation that I could take on that, right? So this is, again, one of those things that as we get to the year end, do I buy a vehicle, right? Well, that's a conversation we'll have a little bit later here. Excess business loss limited, revealed or repealed, nothing really there. Section 179, not too much else there. Some employer credits for the most part. I'm going to skip through some of that because it's probably not super relevant to what we're doing.
Okay. Very good.
Um, some other taxes here, then this is something where I think a lot of times people get confused as like, what am I even doing? Like, what am I paying? Well, there's self-employments, there's taxes, there's payroll taxes, there's unemployment taxes, fed and state income taxes, sales and use taxes, and then each state even has some of their own things. Like I've got a client in Tennessee, they have excise taxes on an S corporation, right? And then Minnesota even has something known as a Minnesota minimum fee. It's technically not a tax, but for all purposes, for all intents and purposes, it's a tax. So just understanding the different like buckets that you're filling up throughout the course of the year can be helpful as well. Now, one of the first things that we look at from a tax mitigation standpoint is, are you in the right entity? Because anytime you are self-employed, you're more than likely looking down the barrel of self-employment taxes. So I'll use myself as an example. I'll say, hey, I'm in real estate. I get my commissions. They get paid to me personally. Or I'm an educator and I've got all of my income and I have no entity set up. I'm set up as a sole proprietorship. Well, all of my profit up to a certain threshold is taxed at about 15.3%, known as self-employment taxes. So that's a portion of Social Security and Medicare tax. So as you earn income, before you even start talking about your federal and state income tax, you're paying Social Security and Medicare tax right off the bat, right? About 15.3. It's at 168 for 2024, 176 for 25. I think they just released the new number for this year. I think it's like 184. that number is only going to continue to increase, right? Because Social Security is a problem, right? It's dwindling. They say like by 2030, it's going to go away. So they're going to continue to increase that. So the sole proprietorship, if I go make 200 grand in a sole proprietorship, I might have close to 30 grand in tax before I even start talking about income taxes, right? So that's where we would say, are you really in the right model? And I'll get to that here in a moment as far as like what entity do I need? Because my cousin told me I needed an LLC. Well, is it actually even doing anything for you? One other thing here is I think there's a big misconception as far as like how am I taxed? Um, Most people I think don't understand, and I should say some people don't understand that we're in a stair step bracket. So instead of learning about the tax tables and rates, we were learning trigonometry and calculus. But for federal and state rates, you go from 10 to 12 to 22, 24, 32, 35, 37%. And then here in the state of Minnesota, we go from 5.35 all the way up to just about 10%. So whenever you land, let's say I made as a single filer, I made $110,000 this year. I would have gone my first basically 12 grand's taxed at 10%, the next up to 48's taxed at 12, and then a good portion's taxed at 22, and then I would just be spilling over into that 24% bracket. That 24% number is my effective rate. Excuse me, my marginal rate. If I were to go say like, hey, I've got another 10 grand coming in at the end of the year, well, how much of that is spoken for? This is something we teach our clients to know that, hey, if make another 10 grand, I've got 24% for Fed and then probably about 7.85 to state. So around 32% of everything that I'm bringing in is going in for just income taxes, right? We want to know what that feels like or how we understand how we're paying in those taxes. One thing to consider is if you're in that sole proprietorship, you've got that in this instance 12% to Fed, 6 to state, another 15%. Well, if I jump into that next bracket, I'm then going from a marginal rate of 34 cents on the dollar to 44 cents on the dollar. So things can jump up very quickly. And frankly, in the United States here, especially in Minnesota, you don't have to make that much money to get close to 44 cents on the dollar. If I'm making $110,000 worth of profit as a single filer in Minnesota, my marginal dollars are about 44 cents in the dollar, right? So that's oftentimes where we say, is this making sense? Am I in the right model? Because that doesn't seem fair, right? $110,000 seems like a lot of money, but it really isn't in today's society. So we want to know, is there anything you can do a little bit differently? The other component then here as a business owner is deductibility. The deductibility aspect is so important. This is something Toby and I were talking about, is just some of the products that they have. These are deductible expenses, right? And this would be something that as we get towards the end of the year, we talk with our clients about, hey, is there anything that you maybe should be buying this year, especially for high income years, right? To say like, hey, if next year maybe we're not sure what our income is going to be. Well, we know this year to be a fact as a high income year. Are there certain expenses that we want to bring in? Well, deductions that are pre-tax are extremely valuable, right? So let's say I'll just use simple math here at the 44% rate. Let's say I, as a business owner, and if candy bars were a business deduction, we're going to claim that it is right now. A candy bar for $1 is $1 for me as a business owner because I can take that pre-tax, right? If I'm going to go buy something personally, well, that dollar at that 44% rate, I have to go make $1.79, pay 79 cents, and then pay that dollar. So this is the impact of deductions and how they can change your tax picture. Now, we also don't just say go spend money willy-nilly to get down to zero tax. You can do that. It's not really a great effective tax strategy, but just understanding where your taxes are is very important. Now, Toby, anything you wanted to add in there?
I just think the importance of understanding having a tax strategy. It demystifies the boogeyman. It gives you a path. It gives you really a playbook, even down to the simple part that says, should I have an expense this year, which is a dollar, $1 expense, and what does it really cost me? Well, really, that expense really just cost me a dollar, as opposed to if I don't do it properly, I'd have to make $1.79 to pay a dollar if I'm paying the taxes on it, right? If it was just,
Yep.
and so understanding that little bit, I mean, those are huge savings. I think about how our partners in our schools, and you're on right now. I know it. You can drop it in the chat if you if you think I'm being crazy, but you know to have to make $1.79 instead of a dollar, that's a huge leap in revenues. That's a huge leap in business. That's a huge leap in market share. That's a huge leap in, pricing your products to try to be able to do that on everything. And so, to me, being successful in a school business, being successful in just about any business, isn't necessarily always some giant home run ball. Lots of times it's all these little decisions that stack up to 3% here, 4% here, 5% here, 79 cents here. Stacking all those little wins up is where you start to get healthy margins that allow you to be profitable, that allow you to reinvest in your business. And then that's when we see businesses grow, is when businesses are profitable. They have the ability to expand when there's opportunity. So a good tax strategy, I think, and I'm sure you agree with me, Zach, allows you to be prepared, take advantage, and then take that and use that to grow your business or whatever you want to do with that money.
Yeah. Yeah, and I couldn't agree more. And one of the things is I'll talk about here pretty quickly is kind of the home run hitters as far as like taxes. It'd be like, hey, what are the big swings? It's going to be this conversation here, but also Toby really hit on an important point is it is the cumulative effort of tax planning that gets you to that post-tax net result, right? To say, hey, we have the knowledge base for these dozen different items that on their own as a face value, maybe a couple $100, maybe $1,000 here or there. But in the cumulative approach, that is a major tax savings, not to mention we compound that over 20, 25, 30 years of running a business. These are real dollars, right? These are not like, hey, it's a whatever. It's all about implementing the knowledge we know, right? And just starting to take advantage of those different things. The other items then, the bigger ticket items is, am I even in the right business model or the tax model for my business, right? So for sole proprietorships, this is very common, right? And sole proprietorship is the same thing of like, hey, I'm in business for myself, or I have a single member LLC. There's a lot of confusion around that where people are like, well, I went and got an LLC to help reduce my tax savings or increase my tax savings. That's not the case, right? You would have to be looking at maybe making an election to get you away from just a single member LLC. Single member LLC is taxed the same way as just say like, hey, person down the street running a lemonade stand that's just getting income to themselves, taxed the same way. Sole props have some benefits, right? They're cheap. They're easy to run. There's not very much complexity. Shows up on a personal return. It's very simple. Back of the napkin. Here's my income. Here's my expense. Here's my net profit. The issue with that sole proprietorship is that you have all of your profits subject to SE tax, right? That 15.3% up to those thresholds. Now, so I would say it's a good
Medicare, Medicaid, Social Security, that self-employment tax,
exactly.
everything under sole proprietor is going to be you're going to hit immediately at 15.3%.
Before we even start talking about income taxes, right? And that's how you can get to that 44% really quickly is because you're just getting through those tax brackets and then you're hitting that 15.3%, which can work, right? If you're just in business for yourself or you're just getting started, or maybe you just don't have a business that's going to scale or kind of lower on the profit side of things, well, you don't need to go to an S corporation because S corporations are going to be more expensive to run. They're more complicated. You got to have a better knowledge base. And either you got to learn that or you have like a partner, like a business by design or an accounting firm that teaches you and walks you through some of it. And then also kind of has some of the model and the background to where you focus on what you need to be doing. We handle the tax component. So S corporations are kind of the next progression for a lot of people, just because once you start making a certain income threshold, you just naturally progress to the S corporation because your profit is no longer subject to SE tax. Now, there's plenty more that I'll talk about here in a second. C Corps, we're going to kind of skip over that. Yes, you could get into a C Corp. And then partnerships, rental properties. I'm not going to touch on too much of that here today. Ultimately, you want to know, am I a sole prop and am I making enough to maybe move to something like an S corporation? For our group here, that's kind of the natural progression. Usually that,
Zach, quick
yeah,
question. So, funny thing. So, if I'm a real estate agent, we service a lot of real estate agents,
yep,
this group, right? Educators. If I'm a real estate agent, we see all the time, I come in as a sole proprietor. It's very simple. And you
yep.
can do that as a school too. It's very fast market, very speed, low cost. You've already got your social security number. You can operate off of that. Not a problem. Maybe you file a name with the state for your
Yep.
business. That's about it, and off you go. Um, and but generally, we're looking at the people saying, "Oh, you know what? I'm going to set up an LLC
Yeah.
as an individual. Allow me to have some protection from how I'm doing my business, or some liability protection, kind of
Yeah.
separation of assets, and that kind of a thing. But it takes a little more sophisticated. Generally got to have it written up, and there's some great forms out there. Maybe you want to have an attorney help you. There's a little more sophistication. And then when they really get serious and they're like, I want to start a team, I'm not just me doing real estate where I've, got to dabble in here and there. Maybe I got an assistant. Now I want to do a team. We're seeing that progression be I mean, are you seeing it? Are you seeing it's a sole proprietor, LLC, and then S
Yeah.
Corp?
Score.
Yeah.
Yep.
But here you're thinking, well, for these guys, for the schools, you're probably looking at sole proprietor or S Corp. Why not LLC? How's that out of the mix for you?
Yep. So technically, you technically are still an LLC. So the way we set up our clients is that you would be more than likely a single member LLC. We
Ah,
just make an election with the IRS saying, hey, state level, still LLC, still afforded all these protections, but we
but
want to be treated as an S corporation. So, but typically, to answer your question, if you're just a single member LLC, all you're really getting is state afforded protections from a legal standpoint. No tax difference than if you were a sole prop. Your next step would be, hey, I either go file a corporation and make the S corp election, or do an LLC and file the S corp election. There is no just like S corp; it's just a tax election.
got it.
And most of our clients, we move them to the LLC just because it offers a little bit of flexibility, some more maneuverability if you need to move away from that later on.
Got it. Got it. All right.
Um,
Very good.
and then
Let's roll in. Go ahead, quick.
with the LLCs or even just a sole proprietorship, you're just very limited as well. So the pros are it's simple, it's easy, it's cheap. Limitations are you kind of got to spend money to reduce your tax liability, right? So if I've got profit, I'm going to go try to prepay expenses for future years, or I'm going to maybe hold off on some income, maybe put money to retirement. It's just going to be very limited. An S corporation, again, like I said, your profit on an S corporation is not subject to SE tax. So somebody who's a wise guy would be like, oh, great, I'm moving to an S corporation. I don't have to pay any Social Security Medicare tax. Not quite. The IRS does have different rules regarding reasonable salaries. So if you're working in that business, you got to pay yourself a reasonable salary. 9 different factors as far as to what actually comes up with that. With the IRS's definitions, we work with our clients in setting that up. It's ultimately about understanding what your income looks like and then devising a wage or a salary. So somebody like this, they're only paying Social Security Medicare on that wage. And that wage needs to be bespoke to you year over year, right? Because that wage is going to impact your Social Security Medicare tax, what you can do for retirement, qualified business income deduction if you're eligible, PTE if you're eligible as well. So it's one of those things that moving to an S corporation absolutely gets more complicated, but there are significant tax savings and benefits. One of the main ones being SE tax, right? Your reduction in Social Security and Medicare tax. And then here in the state of Minnesota, we have something known as PTE. So again, remember that SALT cap, that 10,000 that's now up to 40,000 this year. Minnesota allows you to pay in a portion of your Minnesota tax, and you get a federal deduction for it, and then a credit back from Minnesota. So if I'm at the 22% bracket and I paid 10 grand of Minnesota PTE, I saved myself $2,200 just by saying, instead of paying it personally and paying it out of the business. So
Yeah.
want to kind of get going through here because I know we're a little tight on time, but I want to hit on some of the expenses.
So let me
Yeah.
just kind of summarize there. So the difference between sole proprietor and being an S corp is you've basically protected $48,000 worth of income
In that instance,
in that income,
potentially, yeah.
right?
Yep. So
Got it.
ultimately, and this is a question I get a lot, is like, when do I make a switch, right? Or when do like I have been a sole prop forever and I'm making 200 grand a year. Well, if you're profiting 200 grand a year, you probably should have been one a long time ago. But if you are an LLC, you're just getting started, you're like, hey, I know my income's gonna increase over the future years. What's kind of my break even? Because again, you're gonna pay more to an advisor, to a tax firm to be able to navigate this space. Your break even is probably 40 or 50K of profit is when you should start thinking about or having a conversation with an advisor like myself or anybody out there who can walk you through what an S corporation looks like. That's kind of that break point.
So 40 to 50,000 of profit after
Yep,
you.
of profit. Top line, we don't care about top line in the world of tax. Sounds great, but in the world of tax, we only care about what your net profit is because that's what you're going to be taxed on.
Got it. So revenues, less expenses, profit, right?
You got it. Yep, exactly. Now, business expenses, right? So this is the question that everybody asks. I don't know if anybody's ever seen Schitt's Creek where they say, what's it's a write-off, it's a tax write-off. Well, who writes it off, right? So there's a lot of confusion about this gray area of a business expense. The IRS does have a definition, and frankly, it's not a great one, but it is a definition. So the business expense is an expense that's ordinary and necessary for carrying on a trade or business. So if it's common and accepted in your industry and then it's helpful or appropriate for your trade or business, you're typically looking at a business deduction. Now, there are some categories where tax law is very clear, like clothing, right? A lot of times people are like, hey, I can't do my job without having clothing. And I would be like, I don't disagree with you. I don't want you showing up to a home showing doing without any clothes on. But the IRS is clear that there's personal use there. Or hey, I've got to get hair plugs because I got to see my clients. Well, again, that's not one of those things where there's personal use components here we got to be careful of. But we go through with our clients, a sample chart of accounts like, hey, what can you take as a deduction? Because this really is the first step in being tax efficient, is knowing what the tax code allows you to take deductions and going and grabbing them, right? Because if it doesn't end up on a tax return, it's just like that candy bar, right? Where that was $1. Well, no, it's not now because it didn't show up on the tax return. It's not deductible. You're now going to have to pay pay for that item with post-tax dollars, right? Your income is just increased. So
Got it.
I'm going to hit on a few of these, but there's advertising, auto, client gifts, meals, postage and delivery. First one I'm going to chat about is everyone's favorite one, right? This is a TikTok advisor again saying like, hey, go buy that Lamborghini. Well, it can work, but for the most part, what you're looking for is larger vehicles, right? So if you're looking for accelerating depreciation, that's the big thing we're looking at is accelerating depreciation through Section 179 and bonus depreciation. You're really looking for vehicles over 6,000 pounds, and then that you're utilizing it more than 50% business use over the useful life of that asset, which is typically 5 years. So that's kind of the thing. You're saying, hey, am I going to be looking to take a big deduction? So for this year, if you've got high income and you're looking for expenses and you're like, hey, my old 2006 Honda Civic isn't really doing it anymore. Well, now I need, I've got the three kids. I want to upgrade to like a bigger Mercedes or a GMC or a truck or something like that. Well, then absolutely, instead of saying like, hey, maybe you don't do that next year, maybe we buy this year, place it into service and take that large deduction. It's all about timing of these expenses as well.
And that
Average
large deduction, is that on the entire price of the car or
It
what?
can be. Yep. So here in the state of Minnesota for federal, yes. So if let's say I bought $100,000 Escalade and I used it solely for business because it comes down to business use percentage. If I had it 100% for business, essentially a fleet vehicle, that 100,000 deduction to me on the Fed, Minnesota doesn't conform to bonus. So technically there's a little bit of add back on the state. We're getting too far into the weeds on that.
Yeah, yeah, yeah. But
But
but, but
the answer is
overall,
yes.
I make $100,000 and I buy a $65,000 rig. I can
Yep.
wipe $65,000 of that income off before you
Yep. The
start
only
calculating taxes.
Yep, the only thing I'd caution with on there is you're probably not 100% unless it's a fleet vehicle, right? Because you're like,
Right.
hey, I gotta take it to the cabin, taking the kids to school or
Yeah.
whatever every now and then.
Yeah.
So just
ABC
scale that
School of Real
back.
Estate. It's all I put my signs on it. That's all we use it
Yeah.
for.
Yeah. So I won't get into the advertising component of that because technically, just because you put your name on the side of a vehicle
Doesn't
doesn't
mean
make
it.
it advertising. So,
Uh,
speaking of advertising, we have a lot of things as far as like gifts, right? People give gifts. Technically, that's limited to $25 per person per year. The workaround would be making that a promotional item. Another piece here that I haven't hit on, that kind of segue over to Toby's pieces here is educational expenses,
Hey, is
right?
there any limit on promotional items as long as it's branded and logoed and.
There is no limit on this. I mean, you want to be careful because if I got $100,000 worth of profit, $150,000 worth of expenses, and I've got now a $50,000 loss with promotional items, you might draw some ire from the IRS. Probably not right now because the government's shut down and IRS has lost like 25%
Yeah, if you were
of
gonna
their
do it,
workforce.
now would be the
Yeah,
time. Yeah.
yeah, don't commit tax fraud. But like if you were to do it, it's not a bad time. But yeah, no, there's no real limit. It's just you want to be careful of like obviously what percentage of my like total
Yeah.
business
Yeah.
expenses is that. And then one other component here is educational expenses, right? Like, hey, if I wanted to, by the end of this year, I've got some income and my income's higher than expecting. I don't really know what next year is, or maybe income might go down next year. You might want to pull some of the expenses that you thought you were going to pay for next year into this year, right? You still have time, and this is conversations I'm having with my clients is, hey, we've got 2 months to kind of figure out what do we want to do to change that number for the profit, right? Because that profit's going to impact a lot of different things we do. So I've got clients that are like, hey, it's a crazy year in real estate right now. I don't know what it's going to be like next year. My income's super high. What can we do? And again, there are times where situational spending does make sense. And that's one of those things for like education, for somebody who's on a cash basis, tax basis. If you pay
Yeah.
for it, you take possession of that. That's a deduction within that year, right?
Yeah.
And you
So if
can
I was to
utilize
just
that.
draw that out to our clients, customers here at Dearborn, you're going to be doing real estate licensing classes and you're buying books for students. Do you load up and buy it this year and take the write-off on that expense if you're on a cash basis, not an accrual basis, you're on a cash basis accounting. Um, you may have a very advantageous situation where you have a business expense and it can all pile into this year. It's when you buy it, as opposed to waiting to next year, even though you know you need it in January or February or March. Um, but depending on your tax strategy, that
Mhm.
makes a lot of sense.
Yeah. And even if you're on accrual, right, you could
Yeah.
still take that deduction within this year. It's ultimately just a matter of like knowing your numbers. And I think sometimes if you don't,
Ah,
maybe you do your own self books, or maybe you don't have a set of books, those numbers may be a little unclear. That's something I would really ask of people to maybe question themselves as well. Like, hey, can I pull a P&L? Can I take a look at that? Do I know what my cash position is? And can I then start making more informed decisions at year end? That's something I see with a lot of people who maybe are coming to business by design is they just don't have that relationship with their accountant to say, hey, we know what your numbers are. Here's what you're looking at for tax. Here's the 2 to 3 different things that you could potentially go and buy if you wanted to do that. And again, the Dearborn books is something that Toby was bringing up as well.
got
So
it.
couple of other items, and then I'll kind of flip it over here to Toby, is you could potentially look at paying your kids. There's some income shifting strategies there. Again, quite a bit of detail, but you got to make sure that things are being done correctly. Health savings accounts, right? Should I be maxing out an HSA potentially if you've got it? I think HSAs are a very powerful tool to put money into a pre-tax account. You can use it for qualified medical expenses. If you're not using it, it's in the market potentially. Some HSAs allow you to do that. And then the big one's retirement, right? So the issue with that is there's different plans, right? There's IRAs, there's Roth accounts, there's SEPs, Simples, 401ks. Which one do you use, right? Well, there's different ones that are actually better depending on which instance you're in, right? If I'm a person who's making $30,000 a year, well, I probably don't need a 401k, right? Because that's probably overkill for what I need, right? Or if I'm making $1 million and I have a SEP, well, that SEP is very limiting, right? We maybe want to start looking at going into a 401k, defined benefit plans, stuff like that. Um, that's kind of all I've got here. I mean, there's plenty to discuss when it comes to year-end tax planning. Trying to cram all of the tax knowledge into 45 minutes here can be a little bit difficult, but I hope you're able at least to pull away some of this information and say like, oh yeah, I should probably be maybe thinking about this or asking these questions, or maybe your advisor's already doing these things. Maybe there's some subtle tweaks you can work on.
Yeah, fantastic. I think a couple big things for me, Zach, and I appreciate you being here. Just in wrap up, I think about it is having a plan takes away the mystery. Having a
Yes.
partner that, if it's you, if you're doing your own taxes, that knowledge base, I know of anything is you become more knowledgeable, you get better at it, the mystery goes away, you're able to take advantage of kind of the tax law, the way they expect you to take advantage of it. Um, but if you don't, and you're not don't want to become an expert, you should have an expert helping you, especially if you're running a business, and especially if you're moving out of that sole proprietorship, and you're like, I'm actually got a real business role in here, and you start getting employees, and you start getting all of that. Having that tax plan, and then once again, making sure you're understanding where you're at any given point during the year. You talked a little bit about a P&L. You talked a little bit about balance sheet, knowing your cash position and where you're at and what your tax consequence is at any given time is empowering. It's
Yes.
powerful for running your own business. And so I know we got people who do this very well. I know there are people who will probably go through this video 3 or 4 times. I know we moved
Good.
pretty quick through a lot of stuff, but I want to say thank you again. Thank you for your brain and
Yeah.
bringing your knowledge to Dearborn. Appreciate that.
Yeah. Appreciate you having me.
Absolutely. Well, I tell you what, everybody, I want to say thank you for showing up today. I want to thank you for being a part of the Dearborn webinar series, and we will be talking to all of you soon. Thank you very much. Thank you, Zach.